Good afternoon, traders. I am still clicking buttons, getting set up here. One of those buttons is the camera position. There it goes. Okay. How are y'all doing today? Glad to see you on what day of the week is this? Thursday. Happy February. Tomorrow's Groundhog Day. Happy Groundhog Day, pre-Groundhog Day, Groundhog Day Eve. Hope you're having a fantastic day. Had a couple of questions in the Discord, so I'm prepping for that. I'm also logging in, and I'm not going to show you my login details to everything. Okay, hang on. I know. Chris, you should have done this ahead of time. I freaking know, okay? Let me know if you're here by saying hi, if you don't mind. We are going to do something fun today. I think it'll be fun. I don't want to take too long to get to that point. All right, rock and roll, we're ready. Plan, execute, profit. That is a cool name. Plan, execute, profit. What is your given name? What can I call you besides plan, execute, profit? There's nothing wrong with that sweet name. It's a little bit harder to say than like Brian or Donna or even Sebastian. Brian's here. All right, let's rock and roll. Okay, so questions from the Discord. Dre, I didn't forget about you, Dre. I'm sure that's not the first time you heard that. Dr. Dre is actually one of my favorite musical artists, like ever. We put on that the California song by him and Tupac in my house way too often. Victor, good to see you. Brian thinks it's funny. All right, let's take a look. So first off, the new book is out. So this is the Secret Investing Book, 2nd edition. I actually don't have a copy of it here. Well, do I? Actually, I do. I take that back. I have an author copy, which was not done. In fact, if you look at it, it's got these like, do not sell this book stuff on it with some notes. And it wasn't ready at the time. So where I'm going with that is you actually have a copy of it in your Discord access right now. Now, it will be available on Amazon. Once they approve it, it's going to take a hot minute. It takes a couple, I don't know, a couple days, couple weeks for it to process through. But once it is, it'll be available as a paperback on Amazon as well. But you, because you are a customer of OVTLYR, have access to it immediately. Now, the way you access it is go into here. You can click this link. It'll take you over to it. Or you can just click this link right here. And you will get the digital download of the Secret Investing Book, 2nd edition, right away. So I would highly encourage you to read that. So the 1st edition I wrote, what year was that? I don't know, 21. And hang on. I just keep a copy handy because I reference it a lot with some notes of mine stuck to it. '22. That was older than that. Either way. 2nd edition has some changes, has some improvements, has some things that are different. So yeah, that is yours free. Just go click the links there. Dre also doesn't want to forget about Dre. Very cool. Okay. Going to try and trade the maximized dividends this month. Very cool. Brian, as you know, maximizing dividends and getting the triple stock profit system is the first chapter of this book. So go check that out. Brian knows all about that. Brian's been with me for a long time. All right, let's move to the questions that I saw in the Discord. First question. Could you please explain why you prefer end-of-day trading as it seems to be most hectic? All right, so let's pop this. So this is the SPY, and this is a 5-minute chart. What I want you to look at are the volume bars at the bottom, okay? So in the morning, they're tall, and they get really flat, and then by the end of the day, they pick up steam. That's always and forever the way that it trades. Always and forever. Now, the reason I do that is because I want to make sure I'm there with the most volume. I mean, it can go day after day after day. Where is the most volume? Every single time, it's either the first couple candles or the last hour. Every time, every single time, it's the same. The volume comes at the end of the day. That's why I trade it. First, that's why I trade it. Second, I learned that from Steve Burns. I don't know if you guys are familiar with Steve Burns. I think I have his book on my desk right now. Okay. I keep reaching over here. I know y'all are wondering, where does he keep reaching to? I have a stack of books on my desk at the moment that I have pulled out of not the cabinet, what's it called behind me? The bookshelf that I have not put away. And so Steve wrote this book, which is highly recommended. New Trader, Rich Trader. He also helped contribute to this book here, How I Made $2 Million in the Stock Market. That's Steve on the back. So, yeah, Steve Burns taught me a hell of a lot. And one of the things that he taught me was trade at the end of the day. You can trade any time of the day, Chris. But you really should just focus on the end of the day. I'll never forget, there was one time where I was trading something. I don't remember what it was. Midday. Let's call it 10 o'clock in the morning. I go to the gym. I come back. It's already at my stop loss point. And I'm like, what the frick? Had I not even traded until the end of the day, I may not have even traded at all. But to see it reverse on me within 45 minutes and already take me out when it was supposed to be a swing trade that lasts, a few days to a couple weeks, I was really frustrated by that. So that's one of the questions I had asked Steve. He's like, listen, man, all liquidity comes at the end of the day. All of the hedge funds, all the market makers, all the big players, all the institutions, all the mutual funds, they all trade on the end of the day. So there's no reason to be buying it intraday unless you want to be a day trader. And I don't, right? I'm not about that life. I've tried it several times. I'm not about that life. I do not want to sit in front of a screen all day. And maybe you're the same way too. I'm all about the swing trades where I can just set my clock and just do my own thing all day. And then at the end of the day, that's when I come in. Second reason that I trade at the end of the day is candles are built like opening, high and low range, and closing, right? So for example, yesterday's candle, there was a gap down, and then all day long it sold off and it closed at the bottom. Okay. I care a lot about what these candles look like. I care a lot about how the stock acts at the end of the day. I'll use a little bit of French, but I give no shits what happens at 10 o'clock in the morning. I give no shits at what happens at 11:30. I give no shits at what happens at 1:30. I only care what happens at the end of the day, because that's what the market move is actually going to be. Case in point, yesterday, right? Where it gapped down, kind of farted all day long sideways, and then really hosed some people by moving up and then slamming back down, right? During this entire time, I wasn't even paying attention to the market. I don't even know what Jerome Powell was saying during that time. I didn't care. All I cared about was the end of day results. And then if you use a lot of data like I do, like backtesting and such, they backtest on the whole candle. There's not a possible way to backtest intra candle. So while I'm not going to get the very last price of the day, I try and get close to it, right? So that's multiple reasons why I do so. Another thing I've explained is market breadth. But what if your strategy continues this way for a while? Will they all be considered transition days? That is a great question. So what I want to do is actually show you my results. So once we nailed the strategy down in July, I murdered it the second half of the year, up 48.77% on 24 trades. I was trading maybe 5 to 10 times a month. That was it. And if you look at this, there are stretches from, let's say, July 20th to August 20th. I didn't do anything. And then I lost a couple of trades. From August 23rd to September 26th, I didn't do anything. And then looks like I lost one or two, and then I had giant winners. But I didn't have all that many, right? Maybe 3 or 4 back to back. And then from November 6th, looks like I lost a couple. And then from November 6th to 24th, I didn't do anything. November 25th or so, I put on another trade and ended the year at 48.77%. Or I should say ended the half year. So yeah, they will all be transition days. And I'm okay with that because I know what can happen when things work, right? There's no reason to get busy. There's no reason to fight the trades, right? There's no reason to fight the trend. You want everything pushing in your favor, right? It's like high tide. Imagine the tide's getting higher, the tide's getting higher, and all you have to do is just drop your paper boat on it and let it go right on into shore, right? But if you're fighting the tide, let's say you drop it at the same point on low tide, it's just going to sit there. Nothing's going to happen. And you're going to get frustrated. But if you go with the market movements, then it makes it a lot easier. And I didn't come up with this, right? I can't say that I did. Sebastian, good to see you. I can't say that I came up with this. I actually studied under Mark Minervini, and he taught me about combining the breadth along with the trend. And by doing so, you're just going to let it work for you. And so one other reason I really like to do this is if we look at, I'm going to go back to the end of 2021. Everybody remembers 2021 because that was the year where it felt like you could buy anything and it went up. I was up was that the year I did? Yeah, I think that was the year I did 175% or 171%. What was it? Yeah, either way, that was the year that I just murdered it all year long. A lot of people really struggled with this as soon as it started to go down. But I stopped trading near the end of the year because if you look at the end of 2021, you'll see the trend started to just drop and drop and drop. Oh, end of 2021, right here. I was like, that doesn't sound right. But yeah, end of 2021, you can see it had been trending down. The market breadth had been trending down for a long time. While the market trend on price kept nudging higher and higher, less and less stocks were helping prop up the market to go higher, right? We started at a high of, let's just say, 80% or so in January, and the rest of the year, the trend for the breadth was down. And you look at this, right? It seemed like all year long, it was going up and up and up. But at some point, there was nobody left to make any new highs inside the market, and then it all started to come back down. The best analogy I ever heard, which is what I like to use, is the market itself, the SPY, the index itself is the general, right? And the general's marching north. Yet all the soldiers that the general's in charge of, they've decided they're going to march south. So if all the soldiers are marching south, but the general's still marching north, you've got a huge disconnect right there. And one of the two is going to break. And I always put my money on the breadth of the market because that's what makes up the index. Now, granted, all of this is to say that's not at all factored into OVTLYR. That's not at all factored into OVTLYR signals. That's how I trade. And I use OVTLYR as signals to go along with the trends, right? And I always like to preface this and say, this is how I use OVTLYR. There's so many different ways that you could use OVTLYR and be really successful. I'm just really comfortable with pulling out big returns and only trading 5 to 10 times a month, and then maybe even going for several weeks or months without doing a damn thing and letting the trades come to me. So that's how I personally trade. I appreciate the questions. I think they are excellent questions. And one of the things I like about OVTLYR is that you've got so many opportunities every single day. In fact, we look at the watch list today. There's 47 on the bull list today and 18 on the bear list today. If these fit your risk criteria, dude, it never ends. It's a constant stream of opportunities coming to you, which I think is really awesome. So with all that being said, that is what I wanted to answer over there. Let's jump into our market analysis. Okay, welcome to the OVTLYR trading room. This is how to trade only 10 minutes a day and exactly how to take the guesswork out of trading. And I like to say that this is my style of trading. I'm an OVTLYR with partner, and this is my style of trading using OVTLYR. All right, so what we want to see here is the 10 over the 20 with price over the 50 on the market trend price trend. Let's go back to today. You can see here market trend is definitely going up. And I've told you all this for a long time. Don't bet against the market trend. Don't be buying puts. It'll eventually work itself out one way or the other, but don't bet against it in the meantime. So we've got the 10 over the 20, prices over the 50. We then look at the market breadth, which you can get on bar chart and just search MMFI. So this is the percent of stocks inside the S&P 500 that are above their own 50-day moving average. So how many stocks are above their own 50-day, which is down here for the SPY. And you can see here, that has been weakening since December and the end of December, I should say. And it got totally smushed yesterday. That big red candle did way more damage under the hood than you even thought about. Look at that. We went from roughly 65-ish% above their own 50-day to now 55%. It really impacted the amount of breadth that's going on in the market right now. So I think we're approaching an inflection point here. Just my opinion. And that's why I'm not trading it, because I don't have a conclusive signal one way or the other. They're not in confluence. So with that being said, I'm not going to trade this today. Today would be considered a transition day. I'm not in the market. I'm waiting for valid market setups. And of course, people always ask, how long do you wait? As long as it takes, right? That's my style of trading. Yours can be different. You can get aggressive if you want to. You can sell iron condors if you want to. I wouldn't recommend that. We're going to chat about that more. You can do anything, right? But in a time like this, the mismatch is so strong with such a strong bearish trend in breadth and bullish trend in price. I don't know which way it's going to go. So I'm going to just stay out and let it resolve itself. And with all that being said, I want to go to our final thoughts right away. Okay, inside of the Discord, I dropped this link. I want you to watch it so bad. We're going to watch it together right now. And I think I've set this up. So we can all hear it together. Okay, in the chat, as this rolls,
guaranteed to
do me a favor and
the
type
lives of anybody who participates.
Number one, if you can hear it, and number two, if you cannot hear it.
Popularity so rapidly that the collateral damage this thing causes when it does blow up will impact everybody. And this strategy is called selling 0-day till expiration options. Now, if you've ever heard of the expression picking up nickels.
So I wanted to spend some time working on this. Thank y'all for that reply. I wanted to spend some time on this today because I am very, very grateful that he put this video out. This video tells the dangers of selling options. Now, I've mentioned it many times that I started trading by selling options. I was completely brainwashed. And when I say brainwashed, I was convinced the only way to make money in the market was by selling options. It's not even a joke. Like when I say I was convinced on selling it, I'm telling you, I dreamt of iron condors. I was having dreams about selling call spreads. I would lose sleep because I was so excited to put on put spreads. I never traded anything undefined. I always contained my risk. But I was so convinced there was no other way to make money in the market than by selling options. And there's a lot of people right now who are about to F their lives up big time because they have not figured that out yet. They have not figured out that selling options is a fool's game. You are, as he describes it here, actually, I'll just let him. I think his name is John.
Options. Now, if you've ever heard of the expression picking up nickels in front of a steamroller, well, this strategy is like picking up pennies in front of a nuclear bomb. And unfortunately, I know a thing or two about getting hit by a financial nuclear bomb because of trading options. Back in 2015, when I was a stockbroker, I had recently become an options trader. For a time period that lasted probably a couple of months, I was selling options like crazy. At that time, they didn't have as many 0-day till expiration options as they do today, but at that time, they still had some that would expire in a couple of days or a week on.
We're gonna watch this for a little bit, and I'm gonna interject. This is gonna go a little long today. I will never forget when the It movie came out, and I went to the mall because I had the day off and I'm just doing my thing. It was a Friday. The It movie came out, and I'll never forget, dude. Like, I was looking at my phone. It was a 0 day to expiration option. The moment I put it on, it started going against me. When I say the moment I put it on, I mean, I couldn't have been 30 seconds after I submitted the button, got filled, and I'm watching as it just goes, against me over and over, minute by minute, draining my account, evaporating my account. And I remember sitting in the theater watching the It movie, looking at my phone. It was like just a handful of other people in there, so I wasn't like being a distraction. Come on, I wouldn't be that guy. But I'm looking at my phone, and I'm like, are you serious? And it had gone so deep in the money that both my call and put, or the call that I sold and the call that I bought, the fine spread, had gone so deep in the money that it was a full loser, wrecking my account. And I'm just sitting there like, not again. Brian, it was clearly the money that I lost, the money that I watched evaporate. IR Condor sounds so good on the TD Ameritrade commercials. Oh, I know, dude. Like, I legitimately would dream in IR Condors. And John in this video, he talks a little bit more about it in a minute. But when I first started trading, and I won't name who they are, but you could figure it out if you listen. The people who I learned to trade from initially, like, legitimately, they just pounded it in your head. You've got to sell premium, sell option premium all day, every day. And anytime there's a stock just trading, there's no reason to not sell an IR Condor on it, because then you can get the call money, you can get the put money, and you can just bank it week after week. And you're going to have like an 80+% win rate. And it's going to be awesome. I had an 86% win rate for that year. 86% win rate, not an exaggeration. But I lost my, basically everything. Because while I was winning 86% of the time, 14% of the time, they were humongous losers. 14% of the time, they would take out 5, 8, 10 winners in one loss. In one loss. So you couldn't ever go, you couldn't trade that strategy because you'd have to be flawless. Flawless. Because one loser is going to take out 10 winners? No. That is not the way to sustainability and profitability as a trader. Dre says, I'm glad you said that. I've been thinking about trading options a lot lately. Dude, I trade options every day, but I don't do it this way. I used to, but I don't do it this way. Brian says, apparently crystal meth sounds good to people too. Okay, now that is funny. It's not what you earn, it's what you keep. Precisely. All right, let's keep going.
Indices or individual stocks. I would sell both calls and puts on individual stocks and on the market as a whole. It was almost guaranteed. I felt like I was printing money. I felt rich. I felt like a god. I started off with just a couple of $1,000s in my trading account, and on every trade, I was making a couple hundred to sometimes a couple $1,000, to the point where sometimes even on a single trade, I would make more than I made in an entire month's salary. I thought I was taking on zero risk. Option buyers were paying me for. I thought they were the suckers because they were walking away empty-handed, and my account was going up and up and up. Just for some context at this time,
that was how it was sold to me. His experience was how it was sold to me, and I felt like I was the only idiot in the room who couldn't figure out how to do this. Right? Legitimately, I was convinced. Just do that. Just sell calls and puts on anything, and you're gonna make money. You're just gonna print money. So I was really glad when he put this out, because it just goes into so much good stuff. All right, let's keep going.
It was still at the very beginning of my career. So I was making $45,000 a year at this point, but in just a couple of months, I had traded my account up from a few $1,000s to about $25,000. And to me at the time, $25,000 was a ton of money. In fact, it was literally everything. And then disaster struck. Just like the house in a lottery, eventually somebody gets the winning numbers and the house has to pay out. But in this case, I was playing the house without being able to set the odds myself. So I had a few trades open that I thought there was no way these things could go in the money.
It's always that way. It's always the trades where you're like, oh, there's no way that this is going to happen. It's always that way.
thought they should definitely expire worthless, but the market made a move I did not think it could make, and in one trade, I lost everything. It completely wiped out my entire account. Now again, to many people, $25,000 isn't a big deal, but think about this in terms of percentages, because a 100% loss is devastating. I was taken out by it. For weeks, probably months actually, I got sick to my stomach every time I thought about it. I had gone from feeling like I was on top of the world, like I was rich, I was making more money from trading than I was making from my paychecks, to overnight feeling like a fool, like I was never going to be able to financially make it, like I was never going to be able to recover from what I had just lost. But it taught
me. And that, as I've said many times, I think selling options is the most insidious trade there is. Insidious meaning that like it's just a ticking time bomb. It is just waiting to take you out. It's waiting for you to get complacent. It's waiting for you to have the feelings that John has here, where you're just like, oh yeah, I can't lose. You put on the trades where it's like, I'm so used to winning that I know that this is going to win just like everything else. So I'm going to, go 10 times bigger than I normally would. And that's when it gets you. You've gotten complacent. You've forgotten all your risk. And then here it comes. We're taking all that money back and more.
Me a very valuable lesson about trading and investing, mainly risk management. Like there's a reason why the best investors and best traders throughout all of human history all have the exact same #1 rule. And it's never give yourself an opportunity to have a large loss. Never.
Thank you, John. I really appreciate that, because part of any good trading strategy is not just the trades you put on, but also the position size. The position size, right? Now, I have a decently complicated way to do it, but it doesn't have to be, right? You really want to risk as little in your portfolio in every trade as possible. And I know you're thinking, why would I risk as little as possible, Chris? I want to make the big bucks. When you're wrong, you want to be wrong small, okay? And when you're right, you want to have a big enough position where it allows, the profits to come to you. But if you just throw everything into every trade, there will be times where you get totally freaking hosed. Like for me, last year, while I was still tweaking with my OVTLYR strategy, I lost 19 trades in a row. You think John could have lost 19 trades in a row doing this? No, because it was one trade that took him out. I lost 19 trades in a row and was able to come back after that. You've got to think long term in this game. You can't treat trading like a lottery, or else you're going to get smashed, completely smashed.
Expose yourself to something that could blow you up. Risk management is always the #1 key. It's really the only thing that matters in investing. So no matter how good the odds seem like they're in your favor, if there's a 0.001% chance that you'll lose everything, it's a sucker's bet. Stay away. However, many people today have not learned that lesson. Let's take a look at the specific strategy that individuals are using today with selling 0 day till expiration options.
Now, when I was listening to this, I was walking around through my neighborhood, and when I heard him say 0 day to expiration options, I immediately was like, I did that. I did that in the past. And I won't name names, but one of our members in the trading room did this recently, and he was asking for my opinion, and I said it is a matter of time until you like really go belly up with this. I said, you can do this. Take as much as you can, but just realize when the time comes, it is going to bite, and it's going to bite hard, and you're not going to be happy about it.
Very simply, it means that you are selling options that expire on the day that you open up the trade. Now, this alone gives people a false sense of security because they think, hey, there's only a couple of hours until this thing expires, so there's much less of a chance that this could move against me.
It's like, hey, there's only a couple hours till this expires. I'm going to go watch a movie at the mall, and when I get out, I'm going to have more money in my account than I did before then. Speaking from experience.
There's just so little time. So here's the basics of this strategy. I am going to sell a put on something like SPY, SPX, or one of the Magnificent Seven. The Magnificent Seven are the big stocks that are responsible for all of the stock market's outperformance recently, which is Google, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. We're going to focus on Nvidia, which is up a staggering 235% last year, because this is where most of this trading is taking place. And 0 day options trading is one of the biggest reasons why this is actually taking place. Here's how.
Okay, please pay attention to John's explanation here, because I trade, of course, all day, every day, but I don't always think about the mechanics of why is the stock price going up? Clearly, people are buying it. It's in demand, and so it's going up. The way that John explains it, I think he did a very good job, and actually taught me something in the process.
How this works. Everybody is selling puts on these stocks. If I sell a put to somebody, I have the obligation that I may have to buy that stock from the put buyer at any time between now and expiration. Usually that'll only happen though if the stock price drops below the price specified in the put contract, which is called the strike price. So let's look at a concrete example. As of the day of this recording, Nvidia closed at $610 per share. So maybe when the day opened, I would have sold a put contract with a strike price of $605 per share. Now, at some point in the day, I very easily could have sold this put contract for about $1.50. Now, you're probably thinking $1.50, that's nothing. But with options, every contract represents 100 shares. So that $1.50 is the per share price. So we multiply that by 100 to get $150, and I'm probably going to sell 10 contracts. So it'll be $1,500. So the market opens around 610. It goes up and down, but it closes around 610 as well. I sold my puts at 605, which means I am safe. Within just a few hours, the market closes. Nvidia closes at 610. My put option at 605 expires worthless, and I walk away, the lucky seller, getting to keep the entire $1,500 that I collected by taking on the risk of selling that put. And for a stock,
and that's the allure to this, right? Quick money. I can get in, a couple hours later, I can get out. It doesn't even have to move all that much. Just, stay where it's at, maybe come down a little bit, but basically just keep trending in the direction it's going. And that's the insidious part, right? Because you're always thinking to yourself, oh, there's a chance that it might come back and might work for me. In fact, I don't know if y'all remember, but there was a story about Robinhood. Funny story. I actually interviewed with Robinhood right after this happened to be their lead optionist educator. It didn't work out, and thank goodness it didn't, because Robinhood, the company, is not working out so well either. But there was a kid who killed himself because he was selling options, not having any idea what he was doing. And he woke up the next day and it said he had like $700,000 in debt that he owed to Robinhood. But by the time it cleared through Monday, it would have been fine. Clearly it would have been a loss, right? But he wouldn't have been in debt by $700,000 because he was selling options on Amazon before it had split. But the point is that it's such a dangerous game to play because you can lose so much more than you can win. I mean, the risk for this trade is so astronomically against you from the moment you put it on. And that's why yes, you can capture those little gains over and over and over. Like John was saying, pennies in front of a steamroller, but you're really picking up pennies in front of a nuclear bomb.
That only goes up. This seems like a risk-free way to print money, right? Okay, so here's the problem with this. Everybody's doing this trade right now. However, we know that anytime somebody sells something, that means somebody else is buying it, right? For every seller, you've got to have a buyer. So if everybody is selling these puts, who is buying them? Well, the answer is market makers. You see, a market maker's job is to make the market in the security in which they are a market maker, which means they are responsible for making sure that at some price, if somebody wants to buy or sell something, that they will take the other side of that trade. But here's the thing, market makers do not make money on market movements. They're never gonna just take one side of the trade and hope it works out in their favor. They will always stay market neutral. They'll always be 100% hedged because they make their money on the spread between the bid and the ask on anything. They're basically operating like a middleman. Like when you go to Walmart and you buy something, you're paying a higher price than what the wholesaler sold it to Walmart for. Walmart is taking the spread between the wholesaler and you, the retail buyer. In the same way, the market maker is taking the spread between the buyers and the sellers of anything. So,
which I'd like to point out, that's part of trading as well, is knowing that there is going to be a spread. In my strategy that I do every single day, which is why you're here, I look for some very key things. So one of them is having a 50 cent or less bid-ask spread, because I don't want to give up as much spread as I have to. In fact, sometimes with options, the spread, the difference between the bid and the ask price can be as high as 20 to 30% of the whole option contract. So imagine it's a $5 contract and the spread is $1 wide. So let's say it's $5 to buy, $4 to sell, or whatever the case is. You'd have to give up 20% just to get out of the trade, right? You don't want that. You want to have as little a spread as possible. Back to the show.
That's their whole business, is just to make money on the spread. They will not maintain a book that will profit or loss based on market movement. They will always be 100% hedged. So this is where it gets crazy. How do you hedge when you've bought a put? Well, consider the profit and loss scenarios of being on the buying side of a put. If you buy a put, you will profit if the stock goes down, and you will lose if the stock goes up. So in order to hedge that, you need something that will act completely opposite. If the put loses money when the stock goes up, you need something that will make money when the stock goes up. And if the put will make money when the stock goes down, you need something that will lose money when the stock goes down. That way, no matter what happens, you're perfectly hedged. So the question is, what type of instrument can you use to make money when the stock goes up and lose money when the stock goes down? It's very simple. Just buy the shares. And that's exactly what market makers are forced to do when everyone starts selling puts. They have to take the other side of that trade because there's nobody else out there who's buying those puts. They have to buy the puts themselves. In order to hedge, they have to turn around and buy the shares of the stock itself. That way they stay market neutral and maintain a market in those options. So put those pieces together. This means that as the stock goes up and more people pile into selling puts, that causes market makers to have to turn around and buy shares, which drives the price up even more, reinforcing the trading behavior. But that's not even the worst part. These individuals who are selling puts are not just stopping there. They're taking the $1,000, the $2,000 they collect from selling the puts, they're turning around and they're using that to buy calls. So buying a call and selling a put are both two different ways to make money on the stock going up. And they're both two different ways to lose if the stock goes down. So people are selling a put, taking the cash from that to buy a call. So now you have no money down. You financed your purchase of a call to make even more money as the stock goes up. And as more and more people buy calls, who are they buying those calls from? Market makers. Market makers have to sell the calls, which means they have to hedge those short calls. And how do you do that? The same way you hedge a long put, which is buying the shares. So both of these trading strategies that feed in on themselves, individuals selling puts, collecting cash, and then buying calls, are both forcing market makers to turn around and have to hedge their books by buying the shares, which is pushing the stock price up to crazy heights. Now, by the way,
I really appreciated this explanation. I'm going to end it there. I didn't know all that detail, and I am glad to have learned all that. Now, John continues on. I would appreciate if you did go and check out John's full video, because we're only about halfway through. But the flip side is true. When the selling begins, it is selling begets selling. And it's going to be on like Donkey Kong as everybody is trying to unwind the trade all at once. And so you've seen the big meteoric rise up, and it looks like it's only going to go up. At some point, retail is going to be left holding the bag as all the institutions who have also been playing this are getting out. And then when the big institutions start selling, the market makers have to start selling, and then it just tanks at that point. So yes, clearly much longer than I wanted to go today. However, I felt like this was a very justified video to watch. I do not under any circumstance want you to take that sort of risk. And that's why I wanted to spend the time watching this with you. Thank you all so much for coming to today's OVTLYR trading room. I'll see you right back here tomorrow. Have a great day. Talk soon.